As we head into the new trading week, the markets are closed for the weekend. Bitfarms, ticker BITF, ended Friday's session on November 14, 2025, at $2.58 per share. It was an incredibly volatile day of trading following their earnings report, with the stock opening at $2.42, surging to $2.68, and touching a low of $2.38 before settling down just 0.77% for the day. But that small daily move masks the real story. The stock is still reeling from a sharp double-digit plunge on Thursday, and the volume on Friday was a massive 80 million shares, telling you this is a battleground. The common expectation is that this is just another Bitcoin miner, and its stock got hit because earnings missed and the cost of mining is too high. You might be looking at this thinking the story is about Bitcoin's price, hash rates, and mining efficiency. The reality? You are looking at a company that just told the world it doesn't want to be a Bitcoin miner anymore. The Q3 earnings miss isn't the story, it's the motive. The real tectonic shift that the market is struggling to price is Bitfarms' massive $800 million plus pivot to become an AI and high-performance computing data center provider. The panic and confusion you saw last week isn't just about a bad quarter, it's about a complete and total change in corporate identity. For years, the expectation for stocks like BITF was simple. It was a high beta proxy for the crypto market. When Bitcoin was hot, traders on the Robinhood app or SoFi Invest piled in, treating it like a leveraged play. It was the kind of stock you buy for momentum, not for fundamentals. It was the Tesla stock of the mining sector, volatile, narrative-driven, and disconnected from traditional valuation. You bought it, you held your breath, and you hoped Bitcoin would rip. That was the game. But the music just stopped. The company's third-quarter earnings report from last Thursday was the catalyst that pulled back the curtain. The headline numbers were, frankly, ugly. A net loss of $46 million, or 8 cents per share, on $69 million in revenue. Both of those figures missed analyst expectations. But the truly terrifying number was buried in the operational update. The direct cost to mine a single Bitcoin in the quarter was $48,200. With Bitcoin's price volatility, that is a razor-thin margin for error. And it explains everything that came next. It explains why a pure-play mining business is no longer a viable long-term plan for them. This is where reality delivers a knockout blow to expectations. On the same earnings call where they reported those brutal mining costs, the company laid out its new path. This isn't a small side project. Bitfarms announced a massive $588 million convertible note offering on top of converting a $300 million debt facility. They now have a war chest of over $814 million in liquidity, and they aren't using it to buy more miners. They are using it to execute a full-scale pivot. They explicitly announced plans to convert their Washington State facility to support high-performance computing and AI workloads, specifically targeting liquid-cooled racks for nvidia GB300s. One report even quoted the CEO, Ben Gannon, as stating the company plans to wind down its Bitcoin mining business in 2026 and 2027. This is not a diversification. This is a corporate reinvention. They are attempting to transform from a low-margin, capital-intensive, commodity-exposed miner into a high-margin, high-demand AI infrastructure company. This is the kind of complex corporate shift that completely redefines an investment. It's no longer a simple bet for self-investing. It's a deeply complex special situation. This pivot creates an absolute war zone for the stock, and we're seeing it play out in real time. the institutional analysis is completely split. On one side, you have analysts like those at Zacks, who recently slapped a sell rating on the stock. They're flagging the massive red flag of a negative return on capital and the sharply overvalued EV to EBITDA multiple, which is over 100. They see the pivot as a desperate, high-risk gamble. They rightly point out that Bitfarms is late to the party. Competitors like Marathon Digital and Riot platforms are already moving into this space, and they have more capital and a head start. The execution risk is astronomical. Building and operating sophisticated liquid-cooled data centers for AI is not the same as running air-cooled Bitcoin miners in a warehouse. It's a completely different business. This isn't the kind of stock you'd find in the safe Schwab Intelligent Portfolio or a diversified Fidelity mutual fund. It's a high-stakes bet. But then you look at the other side of the trade. On Friday, the same day the stock was trying to find a floor, H.C. Wainwright & Co. reiterated their buy rating. Just 2 days ago, Cantor Fitzgerald raised its price target to $5 a share. This tells you that some of the most sophisticated desks, the ones using professional platforms like interactive brokers, see this differently. They're not looking at the Q3 loss. They're looking at the $814 million in cash. They're looking at a company with expertise in securing large-scale power agreements. And then you look at the institutional filings. This is the most telling part. In the last quarter, major players dramatically increased their positions. We're talking about firms like Jane Street, Susquehanna, and Citadel. These aren't retail traders using Robinhood crypto wallets. These are quantitative, multi-billion-dollar funds. They are making a calculated bet that the market is mispricing this transition. They are looking at the same risks as Zacks, but are coming to the opposite conclusion. They are betting that Bitfarms can pull this off, and that the market will be forced to re-rate the stock from a volatile miner to a premium AI infrastructure play. Perhaps a supplier to the same ecosystem that has sent the nvidia stock and Apple stock to all-time highs. This isn't a stock anymore. It's a high-stakes poker game, and the big funds are all in. So what does Bitfarms actually do? Right now, it's a vertically integrated Bitcoin mining company. It operates 13 data centers in places like Canada, the US, and Paraguay. Its whole business model was built on acquiring low-cost energy, often hydroelectric, to power thousands of specialized computers, or ASICs. These computers run 24/7, solving complex math problems. When they solve one, they are rewarded with a new Bitcoin. Bitfarms would then either hold that Bitcoin on its balance sheet, the HODL strategy, or sell it to fund its operations and expansion. As of their last update, they held 1,827 Bitcoin. For a long time, this was a great business. But the halving event, which cut the reward in half, combined with soaring network difficulty and high energy costs, has crushed the economics. That $48,200 cost per coin in Q3 is the writing on the wall. The old model is broken. That's why this pivot to AI isn't just an option, it's an act of survival. They are trying to leverage their one real asset, their infrastructure, and more importantly, their power contracts to tap into the AI boom. This sets up a fascinating and binary future for the company, one that has very little to do with the price of Bitcoin. There are two clear paths from here. The bull case, the one the big funds are betting on, is that Bitfarms succeeds. They use their $814 million in liquidity and their new financing to rapidly build out their HPC data centers. They prove they can manage the logistics, secure tenants, and run these sophisticated liquid-cooled operations. If they do, the market will have to stop comparing them to other miners and start comparing them to data center REITs or AI infrastructure providers. The stock would experience a massive re-rating. The people holding this in their Fidelity brokerage or Fidelity IRAs would be rewarded handsomely. The bear case, however, is just as likely. The Zacks sell rating is based on this scenario. In this version of the future, the transition is just too hard and too expensive. The $888 million in convertible notes becomes a time bomb of debt. The competition from Mara, Riot, and established data center companies is too intense. They burn through their cash trying to build a business they have no experience in, all while their legacy mining operation bleeds. The stock would slowly, or perhaps rapidly, grind to zero. This is one of the most aggressive corporate pivots I've seen in the sector. The company is at a complete crossroads, and the market is